Awesome.
All right. Hey, good afternoon, everyone. This is Matt Donaghue with Mission Financial Planners. I'm excited to be joined by my partner in crime, Kenneth Hamilton, and also our other partner in crime, Richelle Hopkins from Mutual of Omaha Reverse Mortgage. Today, we're going to talk about what we feel is a super important topic for most people that often gets overlooked, which is some of the strategies for redesigning retirement with potentially using a reverse mortgage. And I'll share a personal story that Ken and I experienced a few years ago with a client who really needed to understand this option when she was trying to make some really important retirement decisions. This is a client who lives in a really expensive part of the country. She had recently gone through a divorce with her spouse was an executive who was a really high income earner for a long time. They had a beautiful home worth about $4 million. The home even had about $1 million worth of furnishings in it. So they'd done really well for themselves. What ended up happening was they got a divorce. So they had one of those silver divorces that occur. And she got the house, she got the furnishings, and she got an alimony check that would last until she hit full retirement age for Social Security. And then the alimony check would stop. So her only income after full retirement age from Social Security was going to be that Social Security check. That was it. And she loved her home. She loved the area. She didn't want to sell her possessions. She had spent a lifetime making that her home. And what she ultimately had to do was consider something like a reverse mortgage to make sure she could stay in the home. Because in an expensive part of the country, and I don't care what part of the country you're in, if you have a $4 million home, I can pretty much guarantee there is no way a Social Security check will even cover your property taxes. So from a planning standpoint for us as certified financial planners, Ken and I look at those types of scenarios and say, hey, you know what? You need to speak with someone like Richelle so she can educate you on what some of your options might be. And, I'm not going to steal any of Richelle's thunder or Ken's thunder, but when we think about it, for me, as a certified financial planner who's got a lot of focus on retirement planning and taxes and things like that, I'm looking at how do we make sure you've got a plan that works for you? Ken's got additional credentials in divorce analytics as well. And so I'll use that as kind of a segue to turn it over to Ken. But from a planning standpoint, Ken, I know you've got a super extensive background as well, and maybe just a little bit of a different focus.
Yeah, and so for the conversation today, I think it really comes down to two factions of folks. There are folks that view their home as an asset, and there are people that view their asset as a prized possession. One is not better than the other, one is not different than the other. But this conversation is really for those that view it as an asset and want to understand how it fits into their overall picture because again, if we've been a homeowner for greater than 10 years, you'd like to see great appreciation of this asset because that's how we view it. And so what are our options? That's what I'm excited to be talking about today.
All right, great. Thank you, Ken. Richelle, take a few minutes to introduce yourself and Mutual of Omaha Mortgage.
Awesome. Well, first of all, thank you, Matt, and thank you, Kenneth. I really appreciate the opportunity to talk about this or to have this conversation about a type of loan that once did not have the respect that it's gaining today. And so I'm really excited to be the messenger, is what I'll call it. I've been doing reverse mortgages for 20 plus years. I did not just hop into the business as I seen retirees start to look for strategies. I've been doing this straight out of college. In fact, I say it's a God thing how I got into reverse mortgages. I actually have a degree in psychology, and what I thought I was going to do after high school, after college, was to work with high school seniors. I wanted to help them figure out, what does life look like after high school? Are they going into university, community college? Are they going into a career, trade school? What does that look like? And so I say I still work with seniors, just a different type. I took a part-time summer job at a little tiny reverse mortgage office back in 2004, and here I am plus 20 years later. And so I've really got to see reverse mortgages evolve. And where we are today, I mean, it's truly redesigning retirement. People are not having the same pensions that they used to. I mean, inflation is a concern, longevity, and those are things that we're going to talk about today. But I have 20 years plus experience exclusively in reverse mortgage. And I say I kind of come in like your sharpshooter in home equity and retirement, right? You guys are going to cover all the other assets and strategies that your clients come to you with, and typically home equity is the largest. And so it's like, how do we take this asset and work it into your overall retirement strategy for a successful retirement? So again, I'm super excited to be here and to present to all of you on the call, and I'm just really appreciative of you, Kenneth, and you, Matt, as well.
Thanks, Richelle. All right, let's go ahead and jump into it. So of course we have disclosures we have to share. Ken and I will be on today's call, so we've already done introductions there. And of course, Richelle, thanks again for the great introduction. So Richelle, how does a reverse mortgage help you set yourself up for success with retirement, or how could it?
Yeah, thank you for asking, Matt. So we're going to talk about that, and we're going to go through 3 strategies as well as case studies of how my clients have used the reverse mortgage for a successful outcome in retirement. So just like I mentioned earlier, retirement today requires more creativity and flexibility. We have big concerns. We have volatile markets, rising costs. People are living longer, right? And so it's like, how can we use this home equity to be a solution? It's often an untapped resource that can enhance financial security. We're going to talk about, coming up here in just a bit, one of the big financial experts that I know, Kenneth and Matt, you both know. I'm going to go ahead and say it right now because I just feel it's fitting. The reverse mortgage used to be viewed as a last resort option. Let's run through all your other assets and then let's look at a reverse mortgage. But today, the sophisticated retiree is looking at a reverse mortgage early on in retirement so they can protect their other assets so they can truly enjoy their retirement years.
So with that, you know, one of the things that we end up working through a lot is where are your income sources, right? And of course, you're always squaring that back to lifestyle. Because, you know, and Richelle, you kind of hinted there as well, right? You have a lot of different people coming in. They have maybe some misconceptions about what this might be or what this could mean for them. And guess what? If you're a spender in your working years, guess what you're going to be in your retirement years? If you're a saver, guess what you're going to be in your retirement years, right? That pattern of behavior doesn't suddenly change just because you retired. And so that's where setting yourself up for success. Are there risks? Sure. There's inflation, there's healthcare, there is market volatility, there is, you know, all kinds of things, tax code changes and so on and so forth. But at the end of the day, you want to be able to get out and live your life. And if your lifestyle is X, and this can be a tool to help you live X, take a serious look at it, get to know it. And if you want to pick up, you know, and it's great, Richelle, I know, you know, Wade Pfau, I know we're not here to promote Wade, but, you know, if you want to pick up his book on reverse mortgages, it is a great resource. It's very technical, I'll warn you, but it is a great resource. All right, let's keep it moving. Okay.
So, Richelle, you've been doing this again 20 plus years. You must have an ego of granite because I can only imagine the things. Again, reverse mortgages for some of the conversations I've had, you know, just as initial idea with dealing some people that were needing it as a last resort or people asking about it. Sometimes a reverse mortgage was a 4-letter word. So why don't you share a little bit about how it's changed, and then again, why should anybody consider a reverse mortgage?
Thank you, Kenneth. So in my marketing, that I would have up until probably today, I'll say, because I'm rebranding, I would identify myself as a HECM specialist, HECM. It stands for Home Equity Conversion Mortgage, and it's the FHA version of a reverse mortgage. The reason I would do that is because I remember those days when I first got into the business and I would have on my nice, pretty business card, reverse mortgage consultant, and people while I was networking would like go the opposite way. They misunderstood what the loan was. They thought it was predatory lending. We're taking title to the home, and they wanted nothing to do with me. But I knew from the bottom of my heart how this could change lives. So that was how I spun my marketing. I'm like, hey, if I can at least have a conversation of what is a HECM, eventually people would say, is that a reverse mortgage? And I would respond and I would say, that's one version of how to use the home equity conversion mortgage. And we'll talk more about the different versions. But again, I typically danced around the word reverse mortgage because people just didn't know. And I would use a home equity conversion mortgage. FHA reverse mortgage, this is the one that the bank does not put their name on title. Those are old school facts. Before FHA got involved, it's a non-recourse loan. The FHA reverse mortgage, HECM, is a non-recourse loan. You can never go upside down. You can never pass debt to your heirs, nor can we go after any other assets. It is a safe loan. In fact, it's probably safer than most loans out there. Why people would consider it freeing up cash flow and funding dreams. People are limiting themselves in retirement today because they like, hey, I have some money, but what is the market going to do? What are my expenses going to do? What is my health going to look like, right? And so they're limiting themselves in retirement. And truly, Kenneth, this is a time when they should be living it up, right? They've worked for decades, and so they should truly be able to enjoy this time. With that being said, there are things that people do typically in retirement. They're making a mortgage payment, right? But when they remove that mortgage payment, what can they now do with that income? And that's the really exciting part. Truly, being in the business for 20 years, it's not going through the ABCs of reverse mortgage, right? It's how does this loan change the life and the outcome and bring hope back to retirement? Like I mentioned before, longevity risk. People are living longer and they're scared. So the reverse mortgage comes in as a solution to give them peace of mind to truly enjoy their retirement years.
That's wonderful. So to be crystal clear, home value's worth 500 and they do have longevity. If this loan surpasses that $500,000 mark, what happens when when both partners pass away? What would that look like?
The deficit is dismissed. So, and again, we do not know what the housing market is going to do, right?
So when you say dismissed, like, just what is that, like black and white?
So let's say, Kenneth, that the home is worth 500,000 and they owe 700,000 on the reverse mortgage. That $200,000 deficit would be dismissed because they can never owe more on what the loan is due back whenever the home, or I'm sorry, when the heirs receive that home and what they can sell it for, what market value is. If there's any balance exceeding that, it is dismissed.
Wow. Okay.
But just peace of mind. We've seen the market, right? Like looking back, I've been in the business since 2004, so I've seen what the housing market did going back to 2009, 2010. Will we ever get there again? I hope not, but you never know.
Wow. Okay. That's pretty cool. Thank you. Did you have any questions on this slide?
No, but I do on the next slide.
Okay.
And so not to double down on recourse loans, but to double down on the non-recourse loan, right? So in the Wade Pfau book on reverse mortgages, right, he's got this quote that you've highlighted here, and that let's unpack this. Like let's just focus on the first sentence for a moment here. Where the principal limit can be borrowed from the principal limit that can be borrowed from will continue to grow throughout retirement. So explain to everybody, how does that happen? How does that principal amount that potentially could be borrowed, How is that growing? What's it based on?
Great question, Matt. So when somebody sets up a reverse mortgage, we are going to qualify them. The primary factor is their age. The younger they are, the less money they can borrow. And the older they are, the more money they can borrow. It's based on life expectancy. So, like I mentioned, the older they are, the more money they can borrow. When somebody hops into a reverse mortgage, this loan is naturally going to grow in accessibility because they're getting older. So it's just one of the foundations to this loan. We'll talk about it more in the line of credit. We set it up, we say, hey, this is how much you can borrow, and their borrowing power will increase over time. Now, will they have access to that? Depending how they set the loan up will determine how or when they might have access to that. But because they are getting older, the principal limit just continues to grow in accessibility.
So is it kind of two things, right? Like one, the house is growing in value, right? So, of course, we've got that driving it. But if I borrow at 62, I can only potentially get so much. But like you said, if it's set up more like a line of credit, maybe I took out the line of credit at 62, but I don't actually touch it till I'm 75. I actually have a lot more I could access at 75 than I could originally at 62. Or am I overthinking it?
No, correct.
Okay.
And what's
Okay.
really awesome, Matt, this is one of my favorite things. It's not going to be based on what the home value does in the future. This line of credit is going to be growing even if your home is depreciating. So that's what's kind of unique too about this loan.
Okay. So let's explain that to people. How does it grow even if the value of the home went down?
Well, we'll talk about this. There's FHA insurance, mortgage insurance that's involved. And
Ah,
so that insurance does
okay.
guarantee, it
Sure.
guarantees the growth
Sure.
no matter what happens to your home value. And I don't want to go into this story because I know we have a couple other stories, but in 2008, I had a client that came to me who did her line of credit in 2006. And Matt, she was getting ready to sell her home and move with her daughter in Colorado. And it was amazing what she brought in. Her statement, her line of credit was greater than what her home was. She set this reverse mortgage up when her home was up here. And so her line of credit was up here. The market flopped, right? Her home value went here and she still had this line of credit. So this mortgage insurance guarantees that that line of credit will be there. It can never be frozen. It can never be reduced based on the market, and it's guaranteed.
Fantastic. Fantastic. So that second sentence, right, the non-recourse side of it, I think we've covered that, right? On the last slide. So we'll move on to the next point.
So I was talking to my wife about this and how we've helped Richelle, you've helped one of our clients institute this, and she's like, wait, why aren't we doing it? So obviously it's not for everybody. Not yet. So what are some of and let's also be clear, these HECMs are not for everyone, correct? All right.
I agree, Kenneth. I agree. However, I do say if you're age qualified or approaching, get educated. Like Matt, you said it in the beginning. If just get educated because you don't know if it is for you or not for you. I'm a firm believer that if you educate correctly, it really sells itself if it's meant for them, right? So let's talk about the 3 qualifying rules. Number 1, you must be 62 or married to somebody who is 62. And that is on an FHA home equity conversion mortgage, reverse mortgage. There are some proprietary reverse mortgages out there that still have protection like the HECM, but you can be as young as 55. The borrowing limit is less than the HECM, and there's some different pieces to that, but I did want to let you know. Talking about age, again, being in the business for 20 plus years, I've got to see a lot of changes that FHA has made to the reverse mortgage in a very positive manner. 62, as long as one is 62, they qualify. When I first got into the business, if you were not 62, you had to come off title, and the only one that was 62 would remain on title. And guess what? If something happened to that one that was on title, the other one had 6 months to a year to have this home sold or to get this loan repaid. So that's been a nice change with the reverse mortgage. So at least one person is 62. The loan must be used as your primary residence only. I still have a lot of clients that have second homes that travel. As long as the home that they do the reverse mortgage on is the primary residence, they would qualify that property for that. And then number 3, money brought to closing must come from asset accounts or a gift. And that's on a purchase transaction. If they're buying a new home with a reverse mortgage, the down payment that they're bringing to the table, it cannot be borrowed funds. It must be from another asset. Let me go back to number 2 really quick. The property type, we do qualify many different properties from condos to townhomes to single family residence to even manufactured homes. There are some things I must confirm. For example, if it's a condo, we need to ensure that it is FHA approved, or my team will work on getting that approved. And then also manufactured homes, as long as they own the land and it is on a permanent foundation, it would qualify as well. So those are just some points about the property type, but we do a lot of different properties.
So question. Oh, sorry, Ken. Go ahead. Sorry.
Okay, so if these were what qualify people's, what are some of the most common disqualifiers of why they should probably not consider this?
Well, number 1, the home isn't their primary residence, right? The home that they're looking at doing the reverse mortgage on is not their primary residence. Also, I asked the question up front, is this your forever home? I had some people that say, well, these stairs, we're concerned about the stairs. And I'm a firm believer that a reverse mortgage should be done on your forever home. And so that's, again, one of the questions I ask. And if they say, I don't know, then I start talking about the purchase. How can we take this asset and get into the home that is really fit for you? I have other, why it might not be fit for some people if they're concerned about what might be left to their heirs. Oh gosh, Richelle, we're using this equity right now to enjoy our retirement, but our concern is it'll diminish what's left to the heirs. And that's where we have a conversation. Okay, what's most important to you? And then they go back to, Ken and Matt, and they start to look at their other assets. What are other things I could pass on, to my adult children or to my beneficiaries? Home equity isn't just the only thing, right? So, based off their goals, Kenneth, we'll say, okay, well, maybe this isn't for you, or let's wait. But yeah, it's many different reasons why it might not, but those are usually the primary.
Perfect. Matt, you had your question?
Yeah, I do have a question. So if we had a married couple who are staying married legally in retirement for whatever reason, but they're living in separate homes to the point where one's driver's license is this, the other one is that, and they are 2 separate primary residents, could they each do a reverse mortgage, or is that something an underwriter is going to say, you got to pick one because you're married?
Right. We would definitely lean back on the marriage itself for the
You would?
underwriter
Okay.
to review.
Okay.
Yeah. And same thing, even if they're married, but they've went for separate ways, but they've remained on paper, the spouse that they're married to would still have to go through one of the protections of reverse mortgages, that counseling session at the beginning. They want to make sure, especially in a community property state, those are things that we definitely have to dot our I's and cross our T's.
Okay. Okay, great. Thank you. So let's get into strategies. We've talked a little bit about line of credit. So just for a primer, because I'm sure most people watching or listening know what a line of credit is, but maybe they don't. So Richelle, could you talk about, what is a line of credit, and then jump into how does it fit into the reverse mortgage strategy?
Perfect. So a line of credit is simply a portion of their equity that is reserved for them to tap into at any point when they need tax-free money when they need it. I have one of my clients that I talk about, his name is Rick. Set it up early, use it smartly. That was Rick. Rick was in his early 60s and his parents were in their 90s and doing well. Rick, again, feared longevity. He said, well, wait a second, Richelle. I don't really need the money now. I have a little bit of money there, some here. I don't know how it's going to return on investments and things like that. But what I want to do is set up this line of credit in my 60s, my goal is to never touch it. But if I need it when I'm 75, 85, 95, it will have compound growth. So Rick, again, his goal is to never touch it. But if he needs to access this equity that he once set up at $200,000 in his 60s, imagine what that compound growth is going to look like decade by decade. So the line of credit, again, set it up early, use it smartly. Most people are familiar with your traditional home equity lines of credit when you go to the bank. You go to the bank. Well, number one, you have to qualify, and qualifying on a fixed income in retirement is very different than our earning years, right? But they would go to the bank, and the banker would qualify them and say, sure, Mr. and Mrs. Borrower, you have access to $100,000 line of credit. Now, couple differences from that line of credit versus a reverse mortgage line of credit, right? If that banker sets up $100,000 and when they borrow from it, or they're going to redo their patio out back, put in some new kitchen cabinets, whatever it is, they're going to have to make a payment. Okay. Yay, it's nice that the line of credit is there. They borrow, but now they have to make a payment. On a reverse mortgage line of credit, if we set up that $100,000 for you, when you borrow from it, you are never required to make a payment back on that for as long as they live in the home. A reverse mortgage repayment, as long as one spouse lives in the home as their primary residence, that monthly mortgage payment is not required. Okay, so that's one big difference. Now let's take that same $100,000. A traditional bank is going to set up $100,000 versus our reverse mortgage line of credit, setting up $100,000. If you go next year and you go to pull out from that traditional $100,000 from the traditional bank, that line of credit is still going to be $100,000 unless, of course, you've been pulling from it. This reverse mortgage line of credit is going to have growth, as we talked about earlier. There is this continuous borrowing power that this is increasing, right? So it's not just $100,000 a year later. It might be $104,000 that they have access to. So the growth in that is a difference. And then the no monthly payment. And then, like I mentioned before, a very unique thing about this line of credit, a reverse mortgage line of credit, is that line of credit is guaranteed to be there for as long as they maintain property taxes, homeowners insurance, and the home as their primary residence. I'll just say it. I was working at Wells Fargo Reverse Mortgage during my first 7 years before they discontinued the program. When the market, but they had bigger things to worry about. But I remember sitting next to my personal bankers, and they were calling their bank customers left and right. They were freezing the lines of credit. They were reducing the lines of credit. And here I am in my reverse mortgage world. My clients didn't have that concern. They had that guaranteed bucket of money, tax-free, to pull out when they want it. And they'll also use it against the sequence of returns risk. I know Matt and Kenneth, you guys are familiar with this term, but to tell our audience out here, let's say you enter retirement and you have this bucket of money that you're pulling an income from, and it's based on the market, what the market returns. If it's a negative return, you're pulling money from an asset that is dwindling, right? So going back to my client, Rick, he said, hey, look, if my money here, there, and there starts to go down because of the market, I'm going to stop pulling an income from that. And I'm going to now look at the reverse mortgage line of credit to take an income instead. Leave my money over here and hopefully let it regain, which it did in the market when people seen a hit. It did regain, right? But instead of continuing to pull from an asset that is depreciating, leave it intact, come over here, pull from your reverse mortgage line of credit. Oh, great, the market's rebounded. Stop pulling from over here and come back over here and pull the money. So lots of flexibility and creativity with that line of credit.
That's fantastic. Yeah. If there's two key themes that I hope people pull out of this, is non-recourse also means that as long as you're in the home, you're not repaying the loan. And the other thing is loan income is not income. A loan is a loan. So it does not show up on your on your tax return every year. It just doesn't. And you talked about early in your career, people, oh, reverse mortgage, it's a dirty word, that kind of thing. The only other instruments that can do that for people where it's truly tax-free income for them are withdrawing cash values out of insurance policies and of course your Roth IRAs. That's it. And a lot of people really underestimate the powerful impact of the tax planning that this can help you with, because there are people out there that, oh my gosh, I've got a big IRA that in my 70s is going to create an enormous required minimum distribution for me, and I retired at 60. Does it make sense for between now and 75 to potentially draw money out of that IRA, get that RMD down for later on in life, but at the same time, set up your line of credit? And in that way, if, Richelle, like you said, other things happen, you still have that line of credit as tax-free, I'll say income, sitting on the sidelines should you ever need it. And keep in mind too that, sorry, I'm just going now. The third biggest point I really do believe for people is, hey, if you never tapped it, there's nothing to repay. So why wouldn't you put one on just in case, future planning? So something to think about, right? Again, not for everybody, right? But it is something to think about.
Matt, real quick, I have to hop in because going back to Rick, so closing costs look very different on a reverse mortgage versus a traditional mortgage, and mostly because of that mortgage insurance, right? Excuse me, but going back to Rick, he said, look, this is like equity insurance. He's my only client, Matt and Kenneth, that paid his closing costs and left a $100 balance. So typically the closing costs are financed. So they, right out the gate, create a reverse mortgage balance that although you're not making a payment, you're being charged interest, right? And so for Rick, he's like, look, this is equity insurance. He's like, I have life insurance. I have insurance over there. He said, what I'm going to do is pay up front. And it was about, in his case, about $12,000. He's like, but look, if I can pay $12,000 up front and it guarantees me $200,000 with growth, he's like, it's a no-brainer. And
Right.
I say that he did leave $100 in his reverse mortgage balance because in order to keep the loan open with that line of credit, you do need a small balance. Obviously, if you paid it off, the loan would be closed. But again, like he looked at it in such a sophisticated fashion in regards to calling it equity insurance. So
yeah, that's fantastic. That's fantastic.
Perfect. And so let's talk through a real life scenario of how this household was able to use it. And I've been stewing and biting my tongue talking about how I could imagine some scenarios of this playing out. But yeah, Richelle, go ahead. Why don't we walk through this case study?
well, I'll give you the formal case study here because I already told you about Rick. Right here we have Janice. She's an unmarried woman, divorced about 15 years, and had a successful career as a tax accountant. She received Social Security income, and she has a 401k and an IRA she created years ago, but she's worried about spending too much. Janice works with her advisors like Matt and Kenneth to keep spending within her plans. However, she wants to travel more and she wants to remodel her home, but without depleting her other assets. This past year, the market has taken a dip. Therefore, her advisor is worried she's taking out too much to maintain her current lifestyle. So here are her options. She can withdraw assets from her 401k and IRA to supplement her Social Security income. Okay. Second option, take out a home equity line, which will add to her monthly obligations. And we just talked about that at the bank, right? If they go to the bank, if they pull money, yay, but now they have that monthly payment. And then number three, obtain a reverse mortgage line of credit with an initial limit of $150,000. So the outcome, Janice chose option number three. She now has access to $150,000 line of credit, allowing her 401k and her IRA assets to continue growing. She loves her downtown Japanese restaurant and is now planning a trip to visit her cousin in Oregon, and they have a newly remodeled living space and can use a line of credit for any additional home repairs or medical bills. And we threw that restaurant in there. You don't know how, well, you guys know how many times, but those in our audience, how many times we sit in front of our clients and they're not even comfortable just to go have a nice glass of wine or a nice dinner because they're concerned, like, oh my gosh, you know, the money I have, they fear all the things that we've talked about. And so sometimes a simple great glass of wine or great dinner like makes them light up when they start looking at this accessibility to this line of credit.
100%. Now, like, to put some dates and realness to this, like if this was Janice in March of 2020, folks, let's remind everybody that this is peak COVID. The stock market from February 15th to March 23rd was off 35%, Matt.
Yeah. Yeah.
Okay. Before we started really using reverse mortgages or the structure to help clients build out a retirement plan, one of the terms that even some of you on this call might have heard us say before is developing a non-correlated asset. And what a perfect amount would be is between 3 to 5 years worth of your withdrawals in this non-correlated asset. So in these large financial movements where the market's down 30%, as Richelle discussed a moment ago, liquidating in a down market that's also a taxed asset is like triply bad. So if we had a tax advantage place that we could pull from an account that only goes up, and we were able to ride that wave of what happened during COVID, because I think by the end of April, we were back to February levels. And then we all remember what happened from April to December. So you could have taken that loan, seen all that growth over the rest of the year, paid the loan, and now you're fully whole and complete. Honestly, and then you could also take it one step further, done a Roth conversion at the bottom of the market at March, and all that growth tax free. And then that opens up even more opportunities for you in the coming years as well. But having a pool of money when things are really hitting the fan, as opposed to liquidating from an account that's taxable, that's down, having this could be very beneficial. Richelle, anything you'd like to add to that?
I would, and Matt, maybe you were alluding to this earlier. I do not want to get too much in the nitty gritty of interest rates, but there is a calculation that the line of credit will grow. Because you talk about early or 2020, and then when we look at summer, fall of 2022, right, the interest rates were different. The line of credit will grow at whatever the current interest rate is on the reverse mortgage. It is tied to the one-year treasury note. But let's just say that when you start your reverse mortgage back in 2020, rates were 4%. Okay, so that means your line of credit is going to be growing at 4%, and any balance on your reverse mortgage is going to be charged interest at 4%. Again, you don't have to make that payment still, but it is still accruing interest. This is probably the only time that people want interest rates to rise.
Right.
Going back to Rick.
Right.
Rick said, hey, I want the interest rate to go as high as it can, and there is a cap on these. But again, if rates go up 7%, guess what? That line of credit is now growing at 7%. Rates go up to 11%, it's going to be growing. So there is a cap depending on when you started your reverse mortgage and what the cap was at the time. But when my clients say, well, gosh, Richelle, we're really concerned about the interest rate going up, I remind them, number one, there are fixed and adjustable, but number one, the adjustable rate, it's unlike your traditional adjustable rate mortgage. Interest adjust, your payment adjusts, but your income hasn't necessarily, right? In a reverse mortgage, because they're not making a payment, the volatility of that interest rate isn't as concerning, but it's definitely advantageous when you do have your line of credit growth based on that interest rate.
So Richelle, you might be the only mortgage expert that I've heard from in 2025 who has said it's a good thing if rates go up.
Thank you, Matt, for saying that. You know, it's all about mindset, really.
Yeah,
are you looking at
absolutely.
the glass half empty or half
Yeah.
full? And I will say that when rates went up, my business didn't flop. I just pivoted, right?
Mhm.
I still was here to help my clients eliminate a mortgage payment, purchase a home. But hey, my clients who had a home free and clear, I'm like, wait a second, this is a good thing. How can we set up this line of credit so you can gain that growth in it? So thank you, Matt.
Yeah, you bet. Ken, did you have anything else on this slide?
No. Good.
Okay. Okay, so this is something that's maybe near and dear to my heart. Ken's heard me talk about this quite a bit, is, retiring or moving at some point. I have to wait 10 years to get a reverse mortgage because I can't do it now. But I just gave away my age there. But purchasing that new home in retirement, whether it's just a new home or it's the dream home, right? Or, and I know you get this question loads of times, right? What if I think it's my forever home and then it turns out it isn't, right? So I'm in retirement. I know I want to get that new house. How does it work?
Thank you, Matt. The ability to purchase a new home with a reverse mortgage rolled out in 2009. I can't believe it happened that long ago, and people are still very unfamiliar with it, including real estate agents, that they can use a reverse mortgage to buy a new home. This version of the reverse mortgage is ideal for right sizing, relocating closer to family, or moving to a dream retirement location, right? People maybe want a new modern home with modern amenities. They want community. Right sizing, we left out, I believe we did, downsizing, because downsizing isn't for every retiree. If you're talking to my mom, she wants a big family room for the grandkids, the amazing backyard to have them over. So right sizing is different for everybody, but using a reverse mortgage to purchase that next home, there are some benefits here. Number one, it will increase your purchasing power without a monthly mortgage payment. So based on age, you're going to put a percentage down. The older you are, the less down payment, and the younger you are, the more of a down payment, okay? 50% is probably looking at an 85-year-old, but I like that number because it's easy math, okay? So let's say we have an 85-year-old, and I've had very vibrant 85-year-olds that come and even purchase a new home at that point. They're going to make a one-time down payment of about 50% and never have a monthly mortgage payment on that home. So let's say that they find a $500,000 home. They would make a one-time down payment of about $250,000 on that $500,000 home and never have a monthly mortgage payment. How does that increase the purchasing power? Well, again, if I have an 85-year-old client, with $250,000 cash, and they don't want a mortgage payment in retirement, they're limited to a $250,000 purchase price, right? But now they can take that same $250,000 and go buy a $500,000 home without a monthly mortgage payment. A 65-year-old is probably going to put down about 70%. But again, I like that 50% because it's easy math for our call today. A second benefit, preserve nest egg without depleting your portfolio. The same client that I'm talking about, she wants that $500,000 home, but she only has $250,000, but she has money over there with your firm. The last thing you'd probably want her to do is to go and exhaust this additional $250,000. Who knows what tax implications and things like that, right? So if she can leave that money intact and use that same $250,000 to go get a $500,000 home, that's a win-win. Number three, silver divorce. This is the most unaware conversation in a silver divorce. So Kenneth, thank you again for hopping on, especially with your experience here with divorce analysis. Silver divorce, it's happening. People over 62, maybe they're empty nesters now, right? Their kids are off onto college and life themselves, and they do enter a divorce. At this point, they have this house that they've lived in for 40 years plus, right? Typically in a divorce, what they're going to do is sell the home and each take 50% of that net equity, and now they have to go figure it out with new housing, correct, right? So what the reverse mortgage for purchase does for each of these clients in that situation, it now allows them the ability kind of going back to that number one, it allows them the ability to go buy that home without pulling money from their assets, without a monthly mortgage payment, but now they've doubled kind of their purchasing price depending on age. So here they each think, oh, we're walking away with $250,000. Are we going to rent? We can't afford anything. I don't want a mortgage payment. I've lost half their income. And so by using the reverse mortgage for purchase, it is a way to allow them to still have that success of home ownership without depleting their nest egg or without the burden of a monthly mortgage payment.
Oh, cool. Very, very cool.
I'll pause right there because it also says settle the housing asset with a reverse mortgage. I actually had a client back in 2008 come to me with this before when we were getting ready to roll out the purchase, but before all of this other big discussion about it came out. His name was Dan, and Dan was heartbroken when his wife came to him and wanted a divorce, and they built this house together, and he didn't want to leave this house. He said, hey, unfortunately, I don't have my wife any longer. The last thing I want to do is now not have my home. And so what Dan did was looked at doing a cash out on a reverse mortgage to pay off his wife or his soon-to-be ex-wife. So he's not forced to sell the home to divide the housing asset. So she still got her portion of the divorce through their home equity, and Dan gets to remain in that home and still not have a monthly mortgage payment.
That is fantastic. That is absolutely fantastic. So you talked a little bit about buying, and I really like the way you've broken down the options on the right here. Talk us through this scenario. You know, how often, and I guess I would, as an intro to it, I'd say, how often do you see this scenario?
Gosh, Matt, right now, my business is probably 30% purchase. When we were looking back at 2020, it's about 50%. Mm-hmm. Again, it's just people are looking at, do I pull money from my retirement accounts? I don't want a monthly mortgage payment. And so this comes in and offers a third option on how somebody over 62 can have an option when they buy their next home. So just going through the client scenario, Jim and Sally, both 70. They want to move closer to their daughter in a different city. Their current home is worth about $700,000 with a $100,000 mortgage balance. So that would leave them $600,000 net equity after they sell their home and they pay off their current mortgage. So their options. Jim and Sally are considering paying all cash for the new home or taking out a traditional 30-year fixed mortgage, because that's traditionally what people know, right? Pay cash or go take out a 30-year mortgage. However, Jim and Sally, they do not earn enough to qualify for the mortgage. So I've actually had clients come to me because they didn't qualify on a traditional mortgage and looked at this because it is a lot easier to qualify. So for them, they didn't qualify for the $3,100 a month mortgage payment, and they learned about another option. They can now purchase their home with a home equity conversion mortgage or a reverse mortgage. So looking at those three options, they take their $600,000 and they go pay cash. Yay, no mortgage payment. But how old are they? 70. 70 is young in our world. 70 is young. And so it's like, do they go just dump all cash and their cash is under the ground, right? Option two, a 30-year fixed mortgage. Hey, look, we can put $120,000 down and we have, you know, over $400,000 over here to save. But are they really saving when they have a $3,100 a month payment? How quick will that money go, let alone all their other expenses, right?
So that's a 10% withdrawal rate.
Right.
And so it's gone within 12 years.
Yeah.
Wow. Wow. Yeah. And they're still 70. So
yeah.
The third option, they make a one-time down payment of about $400,000 and no monthly mortgage payment. So in this case, they're able to put in their pocket $200,000 and still not have a mortgage payment. The outcome, I wasn't reading it, I was just kind of going off of the story here. So they use the HECM for purchase to buy no monthly mortgage payments. They have $200,000 cash from the sale of their home, and now they can use that as liquid cash to do what they want, whether that's to secure their retirement, they want to travel, they want to do whatever.
Boy, walking distance from future grandkids, they're probably going to spoil the heck out of their grandkids with that money. So,
And thank you, Matt, for saying that, because a lot of times people think that by doing the reverse mortgage, it's going to eliminate an inheritance. I have clients that are like, look, what if I could gift some of that inheritance while I'm living? Or what if I could use that $3,100 a month that I was going to pay, and now I can go visit them in Chicago, and I can go have a really nice Christmas with them. So it's, again, just changing that mindset and that perspective about what inheritance is.
yeah, no, that's super, super important. Okay, we're gonna just a time check here. We're at about 8 minutes till the hour. So what I really want to do is make sure we talk about strategy 3. We won't get into the case study that backs up strategy 3, but let's just talk through strategy 3 so people have a good idea of it, and then we'll kind of get into the conclusion for today's webinar. So, and Richelle, it's a great thing that we are running up on time already, because it does feel like we just started. So
Yeah, I agree, Matt. Once I get going on the strategies and the stories,
yeah,
especially, right, it
yeah.
is time. Finance. Can you hear me okay?
Yep, we lost you
Okay,
for a second there,
my
but you're
speaker,
good.
yeah.
You're good now.
Okay,
Yep.
so refinance an existing traditional mortgage into a reverse mortgage to eliminate the monthly mortgage payment. So this looks like, if Matt, Ken, if you guys have ever refinanced a loan, you're basically taking your old loan terms and you're exchanging it for a new loan that probably has better interest rates, so your payments dropped, or if you're going to pull out equity, right? So you're just taking one new loan and you're paying off the old loan. That's all a reverse mortgage really is you're taking the new loan that is a reverse mortgage, and we're paying off your old mortgage that required a payment. And on this loan, the reverse mortgage, you do not have a monthly mortgage payment for as long as one of you, if it's two, live in the home. As long as you pay your property taxes, homeowners insurance, or your HOA, you do not have a monthly mortgage payment. What's really nice is they can make voluntary payments if they ever wanted to, or pay it off. There is no prepayment penalty. So let's say that the client doesn't mind making a payment today. My thought is, hey, refinance that reverse mortgage. I'm sorry, refinance your old mortgage with a reverse mortgage and make that voluntary payment still, because guess what? You don't know when life happens. My dad had a stroke back in 2008. I remember my mom in the emergency room figuring out how they're going to move money around to take care of things until they figure out, my dad survived and is doing
Good.
amazing. But you never know when life is going to hit you. So I think about that. My mom wasn't old enough to qualify back then, but I think about that. If she was age qualified and had a reverse mortgage and was even making voluntary payments, and life happened, she can just stop making that payment. There is no penalty, nothing. Just stop making it. If you want to continue making it again, great. If not, who cares? We don't care. So that's the exchange of the reverse mortgage and paying off your old mortgage. Nothing really scary about it. They're still on title. They still own the home. Again, make a payment if they want. Improve monthly cash flow. This is typically the biggest financial burden in retirement, is that monthly payment. So if you can eliminate that monthly payment, imagine what you can do with that money. Reduce withdrawal pressure on retirement accounts. Some people are pulling out of a retirement account just to make a mortgage payment. So it's like, hey, stop pulling out, don't make a mortgage payment, and look at what your assets will do. And then the last one here, borrowers can make optional payments to be integrated into tax strategies. And so that's where your team comes in. Again, a payment is not required, but you might say, you know what, let's make a $600 a payment a month to fit into this strategy. So again, they don't need to, but if they meet with the professionals like you guys, and if that's a strategy, that is an option.
Great. Great.
And so since we're skipping the case study, just in round figures, if there was a 70-year-old and, ballparking percentages, what would be that debt to equity ratio for a 70-year-old where they would be able to say all done?
Well, for a 70-year-old, I'm going to say they're going to qualify for about 35% of the home equity. So kind of going back to that purchase scenario, no, line of credit, whatever it was. As long as they have about 35% equity if they're 70 years old. No, if they owe 35%, sorry, then we could reverse
55%.
it. I do have clients as well, Kenneth, that owe more that actually bring cash to the table because, again, they're working out a tax strategy. But really quick, I got to throw this in there, and it might be on one of these nevers. We qualify very different. We're not qualifying you on your ability to make a monthly mortgage payment. We're not looking at your credit score like a traditional mortgage. My clients can have a 550 or a 750. They're going to have the same interest rate. If you have some derogatories or late payments, let's talk about that. It doesn't disqualify you. But with my experience, I'm able to help you overcome that typically. So the qualifying is very different. The 4 nevers, takeaways. Number 1, you can never owe more than your home is worth on the FHA reverse mortgage. And even the proprietary reverse mortgages have that safeguard as well. Number 2, you're never required to make a monthly mortgage payment. Voluntary payment if you want to. Oh, and by the way, if you make a voluntary payment and you have that line of credit, your line of credit will increase dollar for dollar. So that's a whole nother conversation, but there's strategy there. Number 3, you never give up title. I hope I've drilled that in. This is not your 1960 reverse mortgage. You are the owner. Or if you have a trust, your home can remain in the trust. And number 4, that line of credit that we've talked about, it can never be canceled, frozen, or reduced. It's going to continue to grow no matter what your property value does.
Okay,
So
I got a question I gotta ask. I know we're right up on time, but I gotta ask. If you had parents who were living remotely, right? Like in a very rural area, very scenic area, and they are not gonna move, right? Like they are, no matter what, it's not happening. From an estate planning standpoint, have you had or seen people take out a reverse mortgage, pull the cash out, park it in a savings account somewhere, and then that way, when they do both pass away, I would assume in that scenario, now what happens? Is it the cash has to pay off the note and then it's up to the estate to get rid of the house? Or is it now, the bank owns, the bank, right? The bank owns the house and the bank has to handle selling the house.
So if number 1, if they pulled out that cash from the reverse mortgage, that is no longer part of the picture. It just means they pulled out 200, they now owe 200,000 on the reverse mortgage, right?
Yep.
And so that is what is paid from the estate when it is sold. So I think I missed part of it there because I know we're running up on the time, but we're not going to look at that 200,000 in the bank. We're not going to look at anything but for that house for repayment at the end of the day.
Okay. Thank you.
But really quick, Matt, I know we're running out of time. I thought you were going to go a different direction. If they're living up in that home they also want a home closer to the grandkids. I've had clients pull out from their primary where they've done a reverse mortgage and use cash to go buy a home closer to the grandkids and still not have a monthly mortgage payment. So
got it. Okay.
Matt, I have one more question. Can we go a little over time?
Yes, we can. We can go a little over time. Yes, we can.
So back to that $500,000 home. The note is now $700,000. It's exceeded. They've gotten more dollars out of it than what the home is worth. They pass away. What experience are the kids going to have if one of their kiddos decide, I really want that house? Do they have to pay $700,000? Do they pay fair market value of $500,000? How would that play out, Richelle?
A great question. So the loan is ultimately due when if there's 2 borrowers or even one, when the last of them is no longer in the home as their primary residence, right? And that can be they move to assisted living, adult children, typically upon death, okay? That home is now going to get passed on to their heirs. At that point, the heirs come in and let's say they sell the home, right? They owe $700,000, but the home is only worth $500,000. They sell the home and it's kind of like the loan just kind of washes the house. They don't have that deficit they're responsible for, but nor is there equity to be passed on to them, right? You might have an adult child that says, hey, I want to keep the home. The loan is still due back within 6 to 12 months. But if they owe $700,000, but the home is only worth $500,000, FHA will take 95% of that fair market value for repayment. So basically, FHA will take 95% of that $500,000 home, and the loan is settled. So that
So either through
200,000 deficit is dismissed. Sorry, Kenneth.
So either through inheritance dollars or financing on their own, as long as they come up with that 480, they're square. They can, the
Correct.
house can stay in the family.
Correct.
Okay.
Great question.
All right. Well, this has been super informative. If you have questions for me or Ken or Jason, who was not able to make it today, you can see our contact information here. I'm pretty sure Ken's probably throwing it in the chat right now, but feel free to, you can even call us toll free. You can see the 888-339-0093 number. And where I would say you want to engage with us is, how does the reverse mortgage fit into your bigger goal, whatever that goal might be? That's where you want to engage with me, Ken, or Jason, because that's what we do. Where Richelle, as you all learned today, is the expert on reverse mortgages. If you feel like you need to drill down into the reverse mortgage more to learn about what are your options for your specific scenario, then you absolutely reach out to Richelle directly, and you can see her contact information's up on the screen right here as well. But I want to just say thank you to everyone for making time to join us. Ken, also thank you for putting out our YouTube channel and our website as well. So this will be live on our YouTube channel by the end of the week. We're also going to drop a video on Medicare planning, so healthcare planning as well. That'll be live. So everyone who works with us is going to get a big email with all that stuff. Richelle's going to have access to this as well. So if you're working directly with Richelle, she's going to be able to get that information out to you as well. One last thing, and it's super important. Like from a financial planning standpoint, then Richelle, I'll turn it over to you for last word here. From a financial planning standpoint, it's super important to think about the 5 keys, the 5 pillars of your overall financial plan. We just wrote a book on that. Ken, Jason, and I authored a book. It will be live. It is live right now on Amazon, but tomorrow it will be 99 cents if you get the Kindle version. Okay, 99 cents. If you want to pay full price, go ahead. But 99 cents tomorrow only. In that book, one of the key pillars is income. We pair the income plan, and like you heard today, the income plan may have a reverse mortgage in it, right? We pair the income plan. And you heard Richelle talk about this stuff, squaring it back with the asset management plan, the insurance plan, the tax plan, and the estate plan. And Richelle, I think that's part of the reason why I enjoyed the call so much today is you talked about all that stuff, and Ken and I really didn't have to, because you're dealing with it all the time. So if you want to go ahead and get a copy of that book, just go to Amazon, look up the 5 pillars of financial freedom. Ken, I'm sure, is probably going to throw it in the chat as well. But Richelle, take us home.
Thanks, Matt. Well, again, congratulations on the
Thank
book.
you.
I'm sure it's going to add so much value to those that pick it up and read it. One thing that I really appreciate working with your firm is you meet your clients exactly where they are. And I've seen very different clients come from your firm. And that's one thing I like. They're treated as an individual rather than put into a cookie cutter plan. I'm very thankful to have the opportunity to talk about a topic that is not always all glitz and glamour, especially if we look back into my early days in the business, that I'm owning it today. It is what it is. It's a reverse mortgage. And I just say, get educated. You never know how it's going to be a solution that completely changes the trajectory of your retirement years. So thank you both for having me.
Yeah, you bet, Richelle. Thank you. Thank you. And everyone, again, if you do have questions, feel free to reach out. Ken, thank you for throwing all that stuff in the chat. Toll-free number 888-339-0093. Alternatively, just go to our website, missionfinancialplanners.com, click on the Contact Us page. It comes to me, Ken, and Jason, and then one of us will reach out to you directly. Richelle, thank you again. We really appreciate your time.
Take care, everybody.